The end of October saw a 0.25% change in the Bank of Canada overnight lending rate, making it the second reduction in a row. And now the big question everybody asking is, are we at the bottom of the cycle, or is there another surprise coming? Plus, Ottawa dropped their massive federal budget, and this could absolutely reshape interest rates to completely change the path for housing going into 2026. Today, I'm going to be breaking down why an $80 billion deficit could keep borrowing costs higher for longer, what record rental construction, collapsing permits, and project cancellations mean for prices, how the job market weakens, and how mortgage renewal pain is creating a perfect storm for Canada, and what the quarterly October housing numbers told us about where the market is heading next. By the end of this episode, you should have a pretty crystal clear picture of where the market goes from here. The Bank of Canada rate cut. Heading to the last meeting, markets were pricing in a 90% chance of a cut, and they were right. The Bank of Canada trimmed the overnight rate by 0.25 basis points, bringing us down to 2.25%. This move was quite frankly expected, but it comes as a really interesting moment for the economy. On one side, we have inflation that jumped 0.5 in September. Canada supposedly added 60,000 jobs, and consumer spending still looks strong on paper. But the other side, employment remains soft, with most of that work being seasonal. Employment rates sit around 7.1%. And now U.S. trade tariffs are officially dragging down the GDP. The bank even said that these tariffs are fundamentally reshaping Canada's economy, and that's a really strong statement. What's their message overall? The current rate is about right to keep inflation near 2% while helping the economy adjust to those structural shocks. So this is their economic outlook. The 2025 GDP is at 1.2%, 2026 outlook is 1.1%, and 2027 a pickup to 1.7%. That's sluggish. Inflation is expected to hover around 2.5%, easing slowly as supply pressures cool and trade issues settle. So the bank feels like it can cut rates without reigniting inflation, even if the headline numbers look stronger than reality. So what's this mean for housing? At a 2.25 overnight rate, we're basically sitting at the bottom of the bank's neutral range. Any lower and policy becomes formally stimulative. Variable rate mortgages should shift down slightly, hopefully in the early spring. Fixed rates, not so much. Bond yields spiked on the announcement before settling back down. And the bank admits that the labor market is soft, that confidence is extremely fragile, and the U.S. trade dispute is major wild card. Economists weighed in on this. Derek Holt from Scotiabank says we are nearing the end of the cutting cycle. Randall Bartlett from Desjardins says the bar for more cuts is high. And CPA Canada said that the bank is handling the baton to Ottawa. Why? Because Canada's federal budget has already dropped, and the bank wants fiscal policy to carry more of the load. Let's talk about the federal budget, and that's the real wild card. It was announced that there was a $78 billion budget, and we were expecting for that number to land around $80 billion. To put that in perspective, it's about 3% GDP, and it's basically the largest non-crisis deficit in 30 years. Only 2009, 2020, and 2021 saw larger spending. Now here's the key point. Massive government spending means the Bank of Canada doesn't need to cut rates aggressively. When Ottawa steps on the gas, the bank usually steps off. This large deficit could keep rates higher for longer, push bond yields up, and slow down the pace of future cuts. Basically, the bigger budget, the more likely the bank hits pause on their rate reductions. We definitely need to talk about the rental market because it's absolutely flooding with supply right now. This is going to shape prices going into 2026 and beyond. Just over the last 3 months, we've seen single-family new construction home starts down 9.5%, condo starts are down 4.5%, and rental starts are up 26%. On a 12-month basis, Canada has 110,000 rental starts, almost half of all starts nationwide. BC led the country with 15% of all rentals under construction, the highest in Canada. Student permit holders have dropped from over 1 million down to 850,000. Rental demand in college towns are softening, and incentives for rentals are exploding. Lease-up times are getting longer and longer, so the bottom line, renters are about to get far more options, and landlords, not so much. There's not a lot of new construction being built right now for homeowners. Condos, townhomes, and detached properties, those construction levels have fallen to the lowest since 2009. This sets up a tighter resale market for the next 12 to 24 months. Quite frankly, the condo market is collapsing right now. Urbanization's latest report paints a brutal picture for the GTA and Hamilton. It's a little bit different in Vancouver, but it's still not great. New condo sales in Q3, 319 units. Lowest since 1990. That's down 54% year over year. and 92% below the 10-year average. Project cancellations are absolutely exploding across the board. There were 10 projects canceled in Q3, 2,499 units gone because of that, 18 projects canceled year to date, and over 4,000 units wiped out. Since 2024, 32 projects and nearly 7,000 units are not being constructed now. They're canceled. And there's another 20 in receivership or on hold. And unsold completed inventory has skyrocketed up 142%. Nearly 3,000 finished units sitting with no buyers out there. Then we could talk about developer pricing. Asking $1,200 per square foot where the resale market is around $867 per square foot. That's almost a 40% gap. Construction is cratered. Only 2 projects started in Q3. Lowest sales in 28 years. This is all summed up with the condo market is depressed and undergoing a correction after excessive pandemic growth. But lack of supply today will fuel the next upcycle. What about the mortgage renewal wall? We're about 8 months deep into this right now, and people renewing today are seeing about $105 more per month for every $100,000 borrowed. So if you've borrowed $500,000, that means your payment is up $525. That's the steepest increase in payment shock since the 1990s. This could very well last into 2027 when renewal gaps flip negative again, hopefully. The most popular mortgages today, 3 and 4 year fixed. It's about 43% of what we're seeing. Variable comes in second place, and then a 5-year fixed is coming in dead last. Homebuyers are basically hoping and betting that rates will lower when they renew coming up. Mortgage payments for a typical homeowner have now dropped to a 4-year low, back to 2021 levels, which is great. But back then, sales were 50% higher than today. The market's really hurting right now. So what's holding back demand? It's consumer confidence. Consumer confidence levels are below levels seen during the global financial crisis. Canadians need stability in jobs, trade, and in government spending. Time to dive into the job market and the economic outlook. Employment insurance recipients ticked up 0.1% in August, but EI claims are still up 46% annualized over the past 6 months. And 64% of Canadians plan to cut spending because of interest rates. Let's talk about deposits at the banks. They're only up 1.2% year over year, and that's the lowest since 2013. This is telling us that people are really stretched right now. Consumer insolvencies are fairly stable, but we are seeing some foreclosures come up on the market. Business insolvencies, they're actually down right now, but job vacancies, they're down 15% year over year, lowest since 2017. Overall, the job market is very shaky, and that's weighing heavily on demand for buyers. Let's get into the October real estate numbers for the Greater Vancouver market. The month of October was fairly strong, and comparatively speaking to the rest of 2025, median prices were up, average prices were up, but we're not really seeing a turning point because things have gone the other way in November. I'm recording this on November 21st, and the stats for this month are pretty bleak. It felt like October was kind of a one-off, and things have really cooled down again now in November. My final thoughts: between the Bank of Canada's rate cuts, a massive federal budget, collapsing housing pipeline, rental surge, weak job numbers, the mortgage renewal pain, Canada's entering a major transition period, and it's hard out there right now for everybody. Housing isn't in recovery mode, but it's in an adjustment period. This adjustment is going to shape the next cycle. Thanks for watching. I'm Blake Chance with Real Broker. Make sure to hit that like and subscribe.